Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hey audience, this is James Kandasamy from Achieve Wealth through Value-Add Real Estate Investing podcast. And today we're doing a slightly different format. We're doing a podcast plus a webinar, and I have Dr. Glen Mueller here, right? So Dr. Glen is someone I've been following for many years, looking at his real estate market cycle studies. And he's a professor at University of Denver. He has been doing this for almost 36 years, if I'm not mistaken, has gone through many different market cycle. Dr. Glen, why not you tell our audience what I didn't cover in terms of introducing yourself?
Sure. So I've actually been in the real estate field for the past 45 years. Started out as a loan analyst at United Bank of Denver, and by chance got put into the real estate group. After a couple of years, realized that real estate people made a lot of money, went out and started my own construction and development companies, and built custom homes for about 7 years. And then decided that I wanted to have a change and a different lifestyle. So I went back to school, got my PhD in real estate, and started teaching at the University of Denver. Got hired away by a big institutional investor, Prudential Real Estate Investors, and then on to Jones Lang LaSalle, and then started working on the securities side with REITs, Real Estate Investment Trusts, at Legg Mason. I ran the research group there. And then one of my clients, Black Creek Group, invited me to come and head up research for them. And I've been with them now for the past 15 years. And at the same time, teaching as a full professor at the University of Denver. So I guess I'm a typical real estate type A personality running two jobs at the same time. But a lot of my research is focused on real estate market cycles, which is what we're going to talk about today.
Yes, correct. And real estate is very interesting because it's sometimes it's very hard for us to make it into a very analytical format. And when I look at your charts and the work that you do, you have really break it down to science, right? I mean, of course, definitely there's art in real estate, but there's a lot of science to it as well, and it comes from years and years of research, right? Like what you have done, right? And that's very important for people like us who are basically active investors who are buying deals day in, day out, and going through different market cycles. And it's also more important for people who have never gone through a full market cycle, right? Like even for me, I've not gone through a down cycle yet. And there's tons and tons of people who have not gone through a down cycle. So we always wonder how does different cycle is impacted by different property types, right? Like, what you call as like industrial, self-storage, apartments, office, and retail, right? So, and a few other things. So this presentation that you're going to be doing on the webinar and on throughout the podcast, we're going to try to clarify some of the slides that that's going to be covered here, so that the people who are listening to the podcast is going to be able to follow through as well. Although it's going to be difficult, I would advise you to look at the webinar as well.
Right. So if you want, I've got my slides ready to go. We could probably go to that, and I can start in.
Let's start. I mean, I'm going to name this podcast State of the Union of Commercial Real Estate Property Type. So let's go through it. So
throw the word cycles in there someplace, because I do real estate cycles. So let me actually bring that to full screen size to make it easier to see. Is that clear for you?
Yeah, that's awesome.
Okay, great. So basically, I believe that real estate is a delayed mirror of the economy. As the economy goes, so goes real estate. So when the economy is doing well, real estate does well. When the economy turns down, real estate lags by about a year, and about a year after the economy starts to turn down, real estate will turn down. You can see that here in this first chart. And on the demand side of real estate, there are three key things we look at. The first one is population growth. The U.S. population is growing at 0.9%. We are 330 million people, so we're actually growing by 3 million people every year in this country. And let's put that into simple real estate terms. That means that we need to build one city, complete city, the size of Denver, Colorado, which will actually hit 3 million people this year, to give them a place to eat, sleep, shop, work, play, pray, store things, etc. So here you can see GDP growth, the Great Recession in 2009 and beginning of 2010 with negative GDP growth. And then it has rebounded, and it's been running at this nice average of right around just a little over 2%. And the forecast is that looks like it continues forward with a little bit of a dip here in late 2020. But to be honest, economists are always wrong. Their number is never perfectly accurate. And there's a fairly high probability that doesn't happen. The reason for that dip is actually the employment growth below, which again, you can see a negative number back in 2009. It starts to recover and go positive in 2010 and has been running about 2%. And then you see the forecast for a slight decline back down to close to zero in 2021. That's actually a mathematical calculation of the number of baby boomers like me getting to retirement age of 65 versus the number of millennials who are just coming out of school. The only thing, and one of the reasons I believe that number is wrong, is that most baby boomers like me, we enjoy what we do and we're not necessarily retiring. Or if we do, within 6 months to a year, we're out with another job. It may be a totally different kind of job. I live up here in the mountains of Colorado, and a lot of my friends that retired are working as ski school instructors or driving the shuttle bus, or my wife is a host and tour guide at Arapahoe area ski area. So so those people are still working. So that decline in employment growth sort of forecasts the decline in GDP growth, but my guess is that doesn't happen. And a lot of economists now are saying maybe we're in the lower for longer term. As you probably all know, we just hit 10 years of economic expansion. So we're in the longest economic expansion in modern history. And a lot of economists do say, well, it can't go past that. But I don't believe that, because right now the country in the world that's had the longest economic expansion is Australia, and they're in their 28th year of expansion with no recessions. So I believe that the way that we're set up with this more moderate growth is something that is potentially sustainable as we go along. Okay?
So let me recap that, because that's a very important point, because there's a lot of notion out there that, we are too long in expansion cycle, we must come to an end. It's cyclic, right? So, but what you're saying is the way the employment growth and the way that GDP growth, right, has become moderate right now for the past, how many years we have, and that's a good thing. So what you're saying is with that moderate growth, we might be able to go longer on expansion cycle. Is that right?
Right. We're at the beginning of the longest ever.
Correct. So when we talk about Australia, I know it's one of the longest expansion cycle, and things just getting very expensive there. Is that the same case in Australia? Would they moderate growth for a very long time, and that's how they're able to sustain it?
Yes.
And what's driving the 0.9% population growth? Where is the growth coming from?
That is net new births over deaths plus legal immigration.
Okay.
And so we're actually growing at a higher rate than that from illegal immigration as well. But there are more people. We're at a very low unemployment rate at this point in time. So anybody that wants a job basically can get a job.
Okay,
and that's a good thing.
Okay, so I'm going to ask about inflation, and you are showing the chart on inflation. Okay, let's go to inflation.
Right. So on the flip side of the coin is, as we look at by the way, we're talking about income producing real estate, not homes, not home ownership. Okay. So we're focusing on the income producing side of this as we go along. So the two things that we look at, so we've got good demand as we put up new properties for people to use. On the cost side, inflation is running at, again, about 2% and has been since the Great Recession, when it was actually negative. And that is expected to continue. And then we look at interest rates, and of course, we are at. Actually, I'm going to jump ahead here to a different graph. We're at a very low interest rate. As a matter of fact, the lowest interest rates in 60 years. And in income producing real estate, commercial real estate, you can't go out and get a 30-year mortgage on an office building. The longest you're going to see is 10 years. So we look at 10-year treasuries, U.S. treasuries, as our benchmark. And here you can see that 10-year treasuries, and this graph's actually wrong. They forecasted going up to 4%. 10-year treasuries are running a little under 2%. So if you're going to go out and get a commercial loan, you might get it at 10-year treasuries plus a 2% premium. So that would be today, 10-year treasuries are running right about 1.7, 1.8. So you'd be getting a 3.8% 10-year loan on your property, which is a very low interest rate, hence good return to equity on investment after the loan amount. Okay.
So the chart that you showed is basically a forecast, but we are running much lower than the forecast, I guess.
Yes. Yep.
And who came up with the forecast?
Every economist forecasts what's going to happen. The forecasts that we look at many times are the Congressional Budget Office. That's cbo.gov. If you want to go get their stuff, they do 10-year forecasts on GDP growth, employment growth, interest rates, all kinds of different things. So it's a very good place, and it's free to go look at what's happening. And just underneath it, they've got a lot of different things. Just click on the economy one, and all that information will
come. Why do you think the economies are wrong? Why were they forecasting at 4% and we are sitting at 1.71?
It's a statistical method called reversion to the mean.
Got it.
Interest rates over 60 years have averaged close to 6%. So now that it's low, it has to go back up.
Got it.
Right?
Okay.
And every single year they've been forecasting within 2 years, 4%. And every year for the last 10 years, they've been wrong.
Last 10 years, they've been wrong. And
yes.
Is there a chance for them to be continuously being wrong?
Again, there's an old saying for economists, forecast often.
Well, the reason I ask is because every year people are forecasting the interest rates are going up or coming down, but everybody's wrong all the time, right? So
yes,
and it's very important for interest rate for investors like us, like where we are predicting, because we do exit cap rate and we are buying deals, hoping on the, of course, cash flow, but also this market appreciation would be a bonus for us, right? So
right,
that's why I'm asked. Okay,
right, okay. So let's actually go right to talking about real estate and my market cycle analysis. So I believe there's really two cycles in real estate. The first one is the physical cycle, which is demand and supply for real estate. So people renting and space available for rent. And that drives the occupancy rate, which is just the inverse of vacancy. I like using occupancy, and you'll see why here. And occupancy drives rent growth. So if my occupancies are up, which means there's more demand, I can raise my rents. Right? If we're in a recession and occupancies go down, people aren't renting, landlords are going to drop their rents. Okay. And if I add occupancy and rent together, so if I get an increase in occupancy, in other words, I rent more space, and I get an increase in rent, those two together will tell me how much income I'm going to get off my property. That's the physical cycle. The financial cycle talks about the price of real estate, and we're going to do that second, and we're going to do it separately. Okay. So here's my market cycle analysis, and you see that I've got 4 quadrants, just like an economic cycle: a recovery, an expansion, a hypersupply, and a recession phase. There are 16 points on the cycle because historically real estate cycles have lasted 16 years. And so at the bottom, we've got obviously declining vacancy on the way up and increasing vacancy on the way down. We don't build much there in the recovery phase. We build a lot in both the expansion and the hypersupply phase. And then we don't start anything, but we complete buildings that have been started in the recession phase. So actually, we'll go to this slide. So the study that I've done and published that I get quoted on all the time is the fact that if you know where you are in the cycle, you'll know what kind of rent growth you might expect. So you can see here at the bottom, I don't know if my arrow is showing up here or not, but at the bottom of the cycle, points 1 and 2, you've got negative rent growth. So landlords are dropping their rent, right? So if it was $10 a square foot last year and it's going down 3%, right? 3% of $10 is 30 cents, or, it's going to go down to, $9.70 a square foot to rent. As we start to come up through the cycle and occupancies increase, you can see rent growing, and at position 6, at the long-term average there, 0.6 is on the long-term average dotted line. You can see that rent growth was 4%. And during this historic cycle time, inflation was running 4% then. So when you get to long-term average, you get basically the rate of inflation. Then in the green shaded area here, which is the expansion phase, you can see rents really rising quickly to a peak and a high of 12.5% at position 10. Then when we hit the peak of the cycle, which is the highest level of occupancy, after that, rent still grows positively, but it starts to decelerate or slow down back to around inflation at 0.14 and then low and negative again at the bottom. And then one of the things to notice here is that 0.8 on the cycle is green, and because that is the cost feasible rent level. And by that, I mean that if it costs $400 a square foot to build a new office building here in Denver, and investors are looking for a 10% rate of return on that $400 investment, 10% of 400 is $40 a square foot. So rents in the market have to hit 40 before we can cost justify building the new building. Make sense?
Got it. Makes sense.
Right.
Makes sense.
Okay. So every quarter, I look at the major property types, look at that demand and supply, look at the occupancy levels. And as you can see today, 5 major property types: office, downtown or suburban office is at 0.6, downtown office is at 0.8, retail, which will surprise everybody, at 0.9, industrial at 0.10, and retail industrial warehouse up at peak occupancy rates. And the only property type that's over the top into hypersupply is apartment. And apartment is there not because of a decline in demand. We've got all these millennials coming out of school, and so every year demand is going up for apartments, but we're just overbuilding it a little bit. So for my company and for other investors, what I do is I analyze the 54 largest cities in the United States and where they are in their cycle. And as you can see here, they're kind of spread out because demand and supply is very local in nature, right? In other words, what's happening in New York office, which is driven by the financial sector and the stock market, is going to be different from what's happening in Boston or Chicago or New York or any other city. So you can look at the companies that are there, the industry that's driving the growth. And what you see here is national average at 0.8, but some markets moving up the cycle and some markets over the top. And I'll give a quick example here. We've got 2 markets that are in the hypersupply phase, Austin and Houston, both in Texas.
And this for office,
the Austin
right?
market
Office
is driven by technology companies. A lot of tech people, a lot of tech companies like being there because they can hire young people that want to live in Austin. It's a cool city. Yeah, actually, number one growth city.
I am in Austin, yes.
Right. So
it is really cool to live here.
And so what's happening there is, since that's been going on for a few years, the developers are putting up just a little bit more space than you need. So the occupancy rate is starting to come down just a little bit because there's too much space there. So that's a question. That's a situation of too much supply. Houston is exactly the opposite. It's a case of declining demand because the oil industry is driving Houston, and with low gas prices, the amount of exploration and other things going on has dropped off, and they've laid people off. So that's a position of declining demand. So since you're in Austin, let's watch Austin as we look at this. So that's where office is. Here's where industrial is. So warehouse space, again, Austin is just 1 point over the top. A lot of markets are at their peak. Demand for industrial warehouse space has been very strong because of Amazon and people buying things online. So we've got a huge demand growth on the industrial side. And there are some cities, again, where it's easy to build. So we're overbuilding just a little bit. Okay. Now we look at the apartment market, and Austin is at the top at the peak point in 11 because you aren't putting up apartments fast enough for all these millennials moving in. But you look at, there's a lot of other markets where they are putting up a little bit too much space. In other words, we're oversupplying almost half the market. So the national average is just a little over the top. Every time I talk to developers, I'd say, if you just back off on building apartments by about 10% of what's being built, you'll come right back into balance and be back at peak equilibrium point 11. When we look at retail, you can see that the majority of the cities are at peak, and Austin is there as well, which is the one surprising thing because everybody hears about retailers going out of business. We'll talk about that a little bit more in just a second. Okay. And then finally, hotels. Here you can see that hotels, the majority are in the expansion phase with some over the top. And again, Austin, you're oversupplying by just a little bit. Okay. So what I want to do now is jump to and look at the historic cycles. As you said, you haven't been through a full cycle yet. Mm-hmm. Well, here we're going to go back to 1982. And that's a point in time at which I was building. And you can see that occupancies in office were very high. Mm-hmm. It came down and bottomed out in the early 1990s with a small recession, and we'd actually oversupplied a lot. They peaked in 2000 with the technology boom. They bottomed in 2002 and 3 with the technology bubble bursting. Came up to a lower peak in 2006 and 7 as the economy was doing well. Bottomed out in the Great Recession in 2010, and today have come back and are reaching a kind of a lower level equilibrium occupancy level than we've seen in previous times, but it looks like it's going to last for at least another 2 or 3 years. So the other line that you see here is the rent growth line, and you can see that those two are very highly correlated. As a matter of fact, they're correlated by almost 80%. So if occupancies are going up, rents are going up. If occupancies are going to go down, rents are going to go down. Pretty simple and straightforward to look at. So let's look at my forecast. And here's the forecast, and it looks very much like the monitor. And you can see that markets are, again, majority in the expansion phase. Austin, as you can see there, is in the hypersupply phase at position 13. And again, that's because I'm forecasting that you got a lot of new properties coming online. So your occupancy level is actually going to fall a little bit in the coming year. Okay. If we look at industrial, you see basically the exact same cycle of occupancies and rent growth. And we've got this really nice equilibrium that happened back in the mid 90s and another one that's happening today. Rent growth has been really high in industrial because of I call it the Amazon effect, up at 7%, more than double the rate of inflation. And we expect that to kind of work its way back down over the next few years, back to kind of a more normal, by 2017, we expect to see kind of inflation type things there. So again, half the market's at peak equilibrium, the other half building just a little bit too much, but that's the way it is. And Austin, again, just 1 point over the top. Oh, one other thing is you notice I've got some numbers after each city, and those numbers tell you if the city has moved from the previous quarter. For instance, below Austin there, you've got Cincinnati at a +1. So Cincinnati was at peak at number 11, and its occupancies dropped enough for me to move it forward to position 12. So its rent growth is going to be decelerating.
And the bolded city are the bigger cities.
Right. Okay, yeah. So the bolded cities make up, one of the things I found was there's big concentrations. So in each of the different property types, there's anywhere between 11 and 14 cities that make up 50% of all the square footage in all 54 of these markets. So what city is bolded may not be the same in each case. So like Riverside is here in the industrial, but it's not in any of the others. Las Vegas will be in hotels, but it's not a big city for office or any of the other properties. Okay. When we look at apartments, you can see that we actually hit a peak in occupancy back in
2009.
Yeah, we had a peak back in 2014. It looks like we hit another peak here in 2019, but because of the overbuild, we slowed things down a little bit. But going forward, we just have a lot of it in the pipeline, and so we're going to overbuild it. It looks like for the next 3 or 4 years, and hence rent growth, which was as high as 5% back in 2015, has dropped off. And in 2019, I think it's going to run about 2.5%.
So, but looking at that chart, you're predicting 2019, after 2019, rent growth is going to slow down because of the oversupply stage?
Yes. Yep. Exactly. Right.
And does it matter on which class apartment is it, which location, which city, tertiary, primary market?
Oh, well, so here's the cities for apartments, and you can see Austin, I think, is still at its peak. You're not putting up quite enough. Most of the other cities are in that hyper supply phase, right? Where they're putting up a little too much, and so their occupancy levels are dropping. Denver had a number of years of 8% rent growth. And because we're overbuilding, and you can see Denver way over, further down the cycle there, at position 13, our rent growth now is only running about 3%. Okay.
Got it. So, for example, like the city on the hyper supply, going to the recession on the 0.14, right? So what you're looking at is you're looking at the supply that's coming into that city and looking at the demand for that city, and that's where you're determining the 0.14 for that particular city. Right?
That's right. Yep. Because when I combine supply and demand, I can then forecast the occupancy level.
Got it. So,
in other words, in those cities of Memphis, Miami, Orlando, and San Jose, I don't expect them to get anything more than inflation, which is right about 2%.
You mean rent growth, right about 2%?
Right. So their rent growth is only going to match inflation.
So at 0.14, it's supposed to be de-accelerating rent growth, right? And recession, it should be like almost negative.
12, 13, and 14 are decelerating rent growth. And 0.14 is when rent growth should only be running at the rate of inflation, which, if you remember back to your economics class, we have nominal inflation and real or nominal growth and real growth. And all that is nominal growth if rents go up, or if the price of something goes up, that's inflation, right? So if we have 2% inflation, if you've got like GDP growing at 3%, that's nominal GDP growth. So 3% nominal GDP growth, subtract inflation of 2%, and real GDP growth is 1%.
Got it. So what about at 0.11, the cities who are estimated to be at the final phase of expansion, still in expansion, what is the percentage of expectation of rent growth for that kind of cities?
Well, it will vary by city, but it's probably going to be, let's back up one slide there. And when you're at peak occupancy, you've seen historic rent growth as much as here's 4.5%, here's almost 5%. This little peak here is at 3%. Okay. So again, and I do this model that you see here individually for each city. Okay.
How do we get access to that data to get rent growth prediction for each city?
So, that's what researchers do, is we model and project things. And I get my historic data from CoStar, the company that does all the major property types. And I get supply information, demand information, occupancy levels, rent growth, so I can model every city.
But your model of forecast is not available for public consumption, right? That's mainly for your research, I guess.
This is my forecast report that you're looking at here. And my regular market cycle report, I give away free. It's actually on our website at the University of Denver. So if you go to du.edu, and then /Burns School. I'm in the Franklin L. Burns School of Real Estate. Scroll to the bottom of the page and you'll see my market cycle forecast. So you can get those for free.
Got it.
We sell a subscription to my forecast report that comes out 4 times a year. It's only $1,000. And that money goes into a fund to support research on real estate and sustainability.
Got it. So my question is on a specific city. For example, I'm buying a deal in Memphis, right? And I'm trying to do a 5-year projection on my pro forma to show it to my investors and to raise money for it, right? So usually a lot of people use 3% or 2% rent growth for the next 5 years. But what you're saying is that's not correct, right? Because that's not how it's being forecasted.
Yeah, they need to take a look at the city where it is in its cycle, and it might be doing better, it might be doing worse than that.
So how do we get that number? Rather than saying 3 or 2% blindly, is there a place where we can go and say it's 3% the next 1 year, but after that it's going to be 1% the year 2 or second year or third year?
Sure. Yep. So CoStar, you can subscribe to CoStar. And they do projections on all this stuff, city by city, property type by property type.
CoStar do projection. Okay, got it.
Okay. Also, Jones Lang LaSalle has their own research and forecasting group, so you can go there as well. For your individual investors who probably aren't, doing enough to, spend that kind of money on research, most of them are probably working with a broker when they're looking to purchase properties, operate the properties, lease the properties, et cetera. When they're talking to a broker, they should ask, do you have CoStar access for your city and your property type?
Yeah.
And the broker is allowed to share that information and those forecasts with them.
Got it. And what about the cap rate? I mean, when we talk about rent growth deaccelerating, it's also meaning a cap rate being expanding, right? So is there a place?
Okay. So we're almost there. Let me just finish this and then we'll jump right over to the financial cycle. Okay. Here's retail. And the key thing here is that you can see that we are at the highest level of occupancy ever in retail. People go, that doesn't make sense. You got all these companies going out of business and everything else. Right. So Sears is going out of business. One of my students' family owns a mall in Macon, Georgia. And Sears goes out of business. They open up the center roof of the building. On one side, they put in an experience retail, 2 restaurants, a movie theater, and an escape room. On the other side, they're building 4 stories of apartments on top of the space. So they're actually going to have higher occupancy and rent going forward. We're replacing these department stores with experience retail. And remember, supply, we're not building a lot of new retail, number one, but we're also repurposing a lot of retail. So many times a retail center that's not working, convert it to office space. Or today, Amazon's trying to get that last mile delivery to you on the same day. Convert that into close-in warehouse space where you can, deliver to someone the same day. So retail is doing well because it's got a low level of demand growth. It does have some, but it has an even lower level of supply growth, hence the high occupancy rate. Okay, but you can see that the rent growth is really pretty low too. It's only 1% and 2% going forward.
So retail is more of a play of people have given up on retail and there's not many people building, but it's still a demand there. That's why the occupancy is much higher.
Right. So again, most of the market's at the peak, and then hotels. We are again at the highest occupancy rate we've ever seen. That's because millennials like experiences versus things, so they're doing a lot more travel. And we're in the process, because hotels are extremely profitable at that high occupancy rate. We're seeing a lot more new hotels being built. So a lot of markets kind of heading over the top, and Austin being one of those, where you're actually putting up a lot of new hotels. So when you think about it, the one property type that's the best in Austin is actually apartments at this point. Highest occupancy, highest rent growth. So that's the income side of real estate. All we talked about is occupancies and rent growth. How much income can I get?
Yes.
Now let's talk about the financial cycle, and it's capital flows that drive the prices. And we look at that as cap rates. So the blue line's the real estate cycle, the black line's the capital flow cycle, and it should work as when things aren't very good, not much capital. The line's flat there at the bottom. As things get better, capital goes up. The highest rate of growth is when we go through that 0.8, now yellow, where we reach cost feasible rents. Capital flow peaks out in the hypersupply phase and then drops off very quickly. Now remember that we've got 2 types of capital flowing into real estate. The green shaded area up here is capital flows to existing properties. So if you buy a property from me for a higher price than I paid, that's more capital flow. The other capital flow at the bottom is capital flows to new construction, adding more buildings in, so producing more properties. Okay. Real estate, I consider it a separate asset class. So we've got stocks, equities, bonds, and commercial income producing real estate. It's about 20% of the marketplace. So for me, as I talk to and have worked with for 25 years institutional investors, they should have a separate allocation to real estate. You should have a separate allocation to real estate in your retirement account. If you can only do public equities, buy REITs. Directly, you can buy into funds, or you can actually own properties yourself. But remember, when you buy a property, you just bought a business. You got to operate it. You got to rent it. You got to take care of it. You got to maintain it, pay the taxes. You're operating a business. Okay. So when we look back over history, here's the history of 10-year treasuries. You can see it going from 2% back in the 50s to 15% in 1982 to today back to 2%, with a forecast that it's going to go up. But of course, for the last 10 years, that's exactly what that forecast has looked like, and it's always been wrong. We've been running in the 2% range since the year 2010. Notice the total return between 1981 and 2017, is 8.4%. That's because as interest rates go down, bond values go up. Your bonds appreciate. But if you think bonds are a good place to be today, go to the left-hand side. And when you go from 2 to the long-term average of 5.8, the total return is only 1.9, because if you bought a bond at a 2% interest rate, $1,000 bond at 2%, and interest rates go to 4, and you want to sell that bond, the new buyer is going to want a 4% yield, so they're going to give you $500 instead of $1,000 for that bond. So you're going to lose money on your bond. So that's why today bonds kind of don't make any sense. Real estate versus stocks and bonds, it's only had 5 years of negative returns versus over 20 for both stocks and bonds. And it is capital flowing, that money coming in, that makes a difference. So here's a company, Real Capital Analytics, that collects data on every commercial real estate transaction in the U.S. over $2.5 million. Bars go up, the bars go down. And their price index, which is along the top there, you can see follows that pretty closely, doesn't it? Okay. So as more people buy, prices go up. When people back off, like during the Great Recession of 2009, prices come down. Okay.
Is that the international money coming in, or is that local money coming in, or it's just quantitative easing?
I will be answering that question in 2 slides.
Okay. I'm jumping ahead, I guess.
When we look at the cap rate, which is the simple way to describe that, it's like a bond yield or a cash on cash return. Back in 2001, cap rates were around 8 to 9%. And then as prices went up, cap rates dropped to a low in 2007 of around 6 to 7%. Great Recession happened, property prices dropped, cap rates go back up. So you're getting a better cash yield when you buy. Since then, cap rates have been coming down, and they're down at a low of mainly in the 6.5 to 7% range, except for apartments, which are at 5.5. And of course, hotels are higher because they're riskier at 8. And everybody says, well, so interest rates have to go up, therefore cap rates have to go up. Mm-hmm. Not true. All the historic studies done, and I've done some myself, show that the correlation between interest rates and cap rates is no more than about 20%. That's not what drives it. It's capital flow. And as a matter of fact, just came from a conference where 2 different real estate economists say, we expect cap rates to go even lower next year because there's so much money out there around the world trying to find yield, trying to find income, and bonds don't have it. Today, the U.S. stock market, the S&P 500 dividend yield is 1.2%. The 10-year Treasury, which is risk-free, is 1.7%. Corporate bonds are running around 3 to 3.5%, and you can buy into properties earning 6%. So that's quite different, isn't it?
So what you're saying is the cap rate is going to continue. I mean, your prediction is cap rate is going to continue to go down in apartments and is it all asset classes?
Cap rates are most likely going to be staying about where they are or coming, and it depends upon the property type, or coming down just a little bit. They probably won't go down in retail because people don't believe that retail is coming back yet. Okay. Mm-hmm. So one way to look at this is take the risk-free rate of the 10-year Treasury, ask how much additional yield income am I going to get over that risk-free rate of the 10-year Treasury? So that's the spread above the 10-year Treasury. Here, you can see that the spread was 375 back in 2001. It dropped down to only 150 basis points in 2007. But today, you're getting somewhere between 275 and 600 points over the 10-year Treasury for taking that additional risk of investing in real estate. So from that standpoint, real estate looks like a very strong buy as an investment. And because of that, what we see is Real Capital Analytics collects data from all over the world. And this shows money going from one country to another. So at the top, you see the United States in 2018. We don't have the 2019 numbers yet, sorry. Into Spain, put $11 billion into Spain. That was 15% higher than the previous year because they believe the Spanish economy has finally figured itself out and is going well. The next one was France coming into the United States with money, $8.8 billion of French investors buying U.S. real estate. The next one, United States going to the UK, $7.9 billion. That's a 20% decrease. Why do you think it went down?
Because of the Brexit?
Yes. Everybody
uncertainty of Brexit.
When Brexit happens, the the economy in England will go down. And hence, if the economy slows, occupancy rates will go down and rent rates will drop. Okay. So you can see that money moves around the world. And the most expensive property in the United States today would be a Class A office building in downtown New York City. It will go for a 3.8% cap rate. In London, the same size Class A office building will go for a 2% cap rate.
Got it.
In Tokyo or Singapore, a Class A office building will go for a 1% cap rate. So an English investor looks at the US and says, hey, I can buy a top quality property for half price. And a Asian investor goes, wow, I can buy a property in the US for a quarter of the cost in Asia. So we are the largest economy in the world. We're the safest economy. We have good laws that protect investors. In China, you could invest there, but the government, since it's communist, could next year decide that, we own everything anyway. We're taking it away from them. So capital is flowing to the United States, and I believe that keeps prices high and cap rates low.
What about this trade war with China? I mean, I know it's a bit cooling down, but it's cooling down and heating up. And
right.
So how is that going to be impacting the money flow to the U.S.?
Well, we've already hit the first level of agreement on it, and it certainly did not hurt the our economy in any major way. If you look here down at number 7, China and the United States, $8.375 billion, up 8% back in 2018 when it was first in process and our president was threatening, right? Mm-hmm. Chinese investors in the United States went up, not down. Right. Why? Because Chinese investors were trying to get their money out of their country where they thought it might slow down and move it into our country or where it was safer. Okay.
Yep. So this is a very awesome slide because it shows where all the money flows in the world, and right. You clearly see that a lot of money coming to the US, which is important for capital flow to
correct
or real estate prices, right? Okay.
Right. So here's a slide from NAREIT, the National Association of Real Estate Investment Trusts. You can find this on their website, and they're showing historic cycles at being 17 years long. So the first cycle there from 1972, which is when they start having data, through 1989, the green line, the total average return per year for publicly traded REITs was 13.9%. The next cycle, 1989 through 2007, just before our Great Recession, total return was over 14% a year. And here we are kind of halfway through the next cycle, 10 years in. And so far, the average return has been 3.9, but that's because of that big drop during the Great Recession, and you had to recover the money that you lost. So I believe we're kind of mid-cycle and fair amount of expansion to go.
So we are not going to die of old age, I guess, right? Not because of the cycle is too long and we are due for a correction.
Correct.
That's what
correct.
Okay.
So that's my story, and I'm sticking to it. If you want, we can do a quick summary or any other questions you have?
I have a few questions. So in terms of development, right? So in this market cycle, let's say, for example, in apartments, right? So if you look at the apartment, the market cycle that you put in, we are in hyper supply. I mean, of course, you said we have like 10% additional supply. It's not because there's no demand. But is this the right time to do development? Because I saw somewhere in your studies that the best time to start your development is 75% on the expansion cycle, if I'm not mistaken.
Right. I would love to be developing at points 6, 7, 8 on the cycle. That's the best place to be developing.
0.6. So 67% of the whole cycle on the upward trend before it reaches the equilibrium, right?
Well, in other words, go back to my cycle graph, and we want to be. Let's go to the apartment one, as a matter of fact. Yeah. So I would like to be developing at points 6, 7, 8, and maybe 9 in the cycle. What's happening is a lot of people are over here putting up new properties at 12, 13, 14.
So right now, I mean, if your chart shows the apartments at the 13, which means it's not the best time to really do development, I guess, right?
No.
Because you might be entering.
Correct.
And what about, people who, I mean, some of the, investors who are doing like, bridge loans, right? Or long-term loans. I mean, there's pro and con in both, but what would you recommend in this market cycle?
Well, when you say a long-term note, you mean giving a mortgage on a property?
Yeah, getting a mortgage with, agency debt or fixed rate long-term versus a bridge loan, which is a short-term financing.
So bridge loans are basically taking the risks that properties being developed or redeveloped and that it will be successful upon completion. Whereas a long-term mortgage, you get the first money, so the rents that come in have to be high enough to pay your mortgage payment. And if there's nothing left over, then the equity investors aren't making any, return in those years. You can buy an apartment and it most likely is going to cash flow okay, but it's a full-time job to manage a big property, make sure it's done right, finance it properly, and everything else. That's why pretty much every university in the country today has a real estate program. We're actually at University of Denver, the second oldest real estate program in the country, started in 1938. We have both an undergraduate, a graduate, and an executive online program, so you can, be at home and get your master's degree in real estate from us.
Got it. Wow, really? I should probably look at that. But the other question I have, especially on this chart, why is it not symmetrical? I mean, I know during the recovery and expansion, it's just a longer cycle. And after that, like a slide down,
right?
Hypersupply to recession.
Great question. And that's because historically, we've had 11 years of up cycle and only 3 or 4 years of a down cycle. As a matter of fact, I'll go back to one of the slides that I bounced past earlier on, and that is this. Here you can see previous economic cycles. They last anywhere from 5 to 10 years historically, and recessions are normally 1 to 2 years long. The Great Recession at 2.5 years was the longest recession that we've seen since the Great Depression in the 1920s.
Got it. So, and what about the industrial, office, and other property types? What do you think would thrive in the next? I mean, other than apartments, right? Among all these property types, what would be the best property type to invest for the next 5 years? I would say, from your perspective.
Here's the chart. Office has got the longest run in the expansion cycle, followed by retail. Power centers. It doesn't mean that stuff can't sit at the top for a long time too. So if the economy keeps going, I believe we've got a good 5-year run of demand for industrial space going forward.
Got it. But is office being driven by some factor? Like technology, right? I mean, a lot of technology people work from home too, right? So I'm not sure where the drive is coming from for office.
Basically, more and more of the jobs in the United States are office using jobs. And people go stir crazy sitting at home, and we're social animals. And so being together with other people and that social interaction actually benefits the work at every company. That's why we work. When you start a company, instead of working out of your garage, you can now go and rent some WeWork space on a daily, weekly, monthly basis. They charge you plenty for it, but now you've got a space to be in. All the amenities that are necessary there. There's a receptionist, there's copy machines, there's all the different things that you need to be successful, collaboration, conference rooms, all those kinds of things. So most new companies start out by going to, short-term office rental space. Last year, that was 10% of the demand in office.
Got it. And what about the Amazon effect? Is that just on the industrial? Because I read somewhere where they own like 25% of the...
Last year, Amazon rented 25% of all new warehouse space rented in the United States. That's how much they're growing. They opened a 1 million square foot warehouse north of Denver and hired 1,500 people.
What about this boom in marijuana and all that happening on some of the coastal cities? Is that impacting any of these property types? Like they have this marijuana, right? Like medical marijuana and.
Colorado was one of the first, and it created huge demand for warehouse space here in Denver, and drove our rents from $3 to $6 over a 2-year period. Occupancy went to basically 100%. All the old crappy warehouse got rented up to grow marijuana, and since we were one of the first states, marijuana tourism became very big. Now that other states are picking it up, less people are coming, and we've had a couple of marijuana companies go out of business. And so all of a sudden, and we built a lot of new space for them. And so now we're in the hypersupply phase because that economic base industry in Denver is shrinking.
Got it. What would you advise an investor, let's say, for example, in an apartment investor, right, who are, more on the hypersupply stage right now? What would you advise that person to be cautious of as we move forward for the next 5 years? Do we keep on buying, or do you want to be more defensive?
Well, if you believe that there is a recession coming, then what you want to do is have what we call defensive assets. You want to have you want to be in the best markets, the highest, the bigger markets like the ones that I show and the ones that I have in bold and italics. You want to be in higher quality properties that can attract and retain tenants. And you want to try and get the longest term leases you can get to bridge you through the next down cycle.
Got it. What about tertiary market? Is it a good idea to go into tertiary market looking for yield? Because I know some of the tertiary market is, they have a lot more yield, right, compared to the big cities.
Yes, but you have to be careful and very selective. You need to look at what is the economic base industry that's driving the growth in that market. Okay. So, for instance, an economic based industry produces a good or service. It exports outside of the local market that brings money in. So in Detroit, Michigan, for decades, it was auto. If the auto industry did well, so did Detroit. When the auto industry turned down and we got a lot more foreign competition, Detroit became pretty much a ghost town. Now you got a billionaire tech giant who came in and started buying up a bunch of office space in Detroit to run his company out of at next to nothing. And hire people in saying, come here and live. And oh, by the way, you can go buy a new house. You can go buy an existing house here in Detroit for like $10,000 or $20,000. So instead of spending $3,000 or $4,000 in San Francisco in rent, you can have a mortgage that's only a couple $100 a month. So Detroit is starting to turn around because of a new economic based industry. This tech company, creating demand for office. And when you create demand for employment, then people buy things. So retail goes up, demand for rental goes up. It moves everything up. Employment growth is the number one key thing to look at for demand for real estate.
Got it. What about some of the government controls like rent control in some of the cities, some of the states that's happening right now? How is that going to be impacting the cap rate and the rent growth in
right. So rent control is the government interfering with the free market. And it has shown that when that happens, it severely restricts supply because no one wants to build if they're going to end up with rent control on their property where they can't raise rents to at least meet inflation. And so every place where that kind of stuff is coming into play, investors aren't buying and property prices are going flat. It, in the long term, will hurt the market. It will create exactly the opposite. They're saying, we're trying to make apartments more affordable for people. Well, it does just the opposite. The people that are there end up with a lower rent, and then they sit on it even when they now have a good job. And I'll give you an example. I have a good friend who owns an apartment building in San Francisco. He has 4 of his 20 units are rent controlled. One of the people in it was a guy that when he got in, he was in school. Now he is a very wealthy person, and he continues since he had it. It can't be released. He gets his rent is less than 25% of what market would be on his property, and he's there maybe 1 or 2 nights a month. And my friend keeps asking, why do you rent this for the month when you're only here 2 nights? And he goes, because it's cheaper than a hotel. So it's bad government policy, in my personal opinion.
Yeah, it's crazy, right, for investors like us. So does that mean some of the cities which doesn't have rent control will have a lot more price run up because a lot of people want to be investing in like, for example, in Texas or maybe Florida, right, which doesn't have a lot of a lot of states doesn't have rent control. Would that mean that a lot of people from the East Coast or West Coast will be investing more on these states?
Potentially, yes.
Okay. So I think I covered most of the questions that was asked in the Facebook group. If audience and listeners, you guys want to join this multifamily investors group in Facebook, we have almost 4,000 people there, and we are recording this as a podcast and a webinar, so you should be able to get the webinar as well as you register. So Dr. Glen, how do people get hold of you and get in touch with you with your work? I believe you mentioned it halfway through, but you want to...
Right. Yeah. So they can go to the University of Denver website, which is du.edu, and then Burns, Burns School, and scroll to the bottom, and they'll be able to see my cycle reports there. And there's, I've got my profile and all the other information there. That's the easiest way to do it.
Awesome. Thank you very much for coming into the show and doing the webinar as well. Thank you very much.
Okay. Thank you. Have a blessed day.
Have a good day.
Bye.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.